start, especially I think for many of these mid-cap, small-cap movers, which we will come to in just a bit from now. But otherwise, at the index level, it's kind of quiet. 3-1 in favor of advances. The number of stocks up and down is early, but it's indicative of a decent kind of spread. The Adani stocks are all higher. Adani Enterprises Ports, occupy the number 1, number 2 gainers list. And the bulk of the market, at least on the Nifty 50 heat map, shows we're opening in the green. HCL Tech is down and a few others, but just 6 or 7 names on the Nifty opening lower. Otherwise, it's all green. Surabhi.
Look at Grow. It was 10% yesterday. It's down 8.5% today. Now, these kind of technical issues, they do make investors nervous. Not the best of experience you want with an IPO. Touch sky-high levels and then such sharp drawdowns coming through, extreme volatility, and investors are having to stomach it for the time being. The other one is Saman Capital. We're just telling you that in the pre-open it was up about 3%. Well, it's not able to sustain. It's lost that gain and it's actually down about 0.5% right now. So two important stocks, need to see how they shape up. On the large cap screen, like Prashant is saying, Adani is still in leadership position. Big asset they're looking at, obviously, taking over Jaiprakash Associates. So 1% up on Adani. Tata Motors, passenger vehicles, finally manages to rise on the green side of the screen. About 1% up there as well. Reliance is a big support for the market today. 0.6% up on Reliance. Then you have a couple of financials doing well, which includes names like Axis Bank, Jio Finance, Shriram Finance, even Bajaj Finance is up about 0.5%. Financials are actually, NBFCs are doing better than banks this morning. That's one trend that's very, very clear. On the downside, there's HDFC Life, there's ICICI Bank, there's Bharti Airtel. That's pretty much it. And some of the IT stocks, they're cooling off from yesterday's smart run. So HCL Tech, Infosys. Some of these stocks on the lower side of the screen, Nigel.
Well, as Saman Capital started in the green, but just take a look at that stock. Slam dunk from the high. It's down close to around 5% from the high. So for the time being, the stock actually has got sold into that little kind of bounce that we saw. Grow, that's recovered a little bit from the lows of the day, though it's still down close to around 5%. It was down 8%. Physics Wala, the other one, in fact, that is lower, and it's fallen on decent volumes, down close to around 3%. So both those two newly listed companies actually trading in the red, with a fair bit of volume in the first few minutes. Tenneco, one of the newly listed companies, came on board yesterday, trades at more than 20 times EV upon EBITDA, but they believe that there's a good penetration scope out there as you move from BS6 higher. The cost per vehicle will in fact move up. Exports is another big potential. So that one, after the fund-based buying that we saw yesterday, it's up another 3% in today's trading session. What's losing out then? Both those two, Physics Wala as well as Grow, both of them a little bit lower. Sagility is down just around 1% or thereabouts, but volumes quite high on that particular name. I think Vedanta was seeing some green just to kickstart trade, so I think we should get that as well up for you on the screen. Vedanta, yeah, it's good news if in fact they don't go and get over adventurous, so the street is reading it on that way. And besides that, yeah, I think that's about it. Nifty holding with a gain of around 40 points, 26,100. Nifty Bank still to get off the blocks as we speak.
Just wanted to mention, by the way, that while the JP Associates resolution finally gets underway, Jaiprakash Power is the one that's running with a lot of excitement. 10% up on that stock. It's only a 22 rupees stock, but yeah, it's running and the volumes are picking up. Fairly high volumes actually at this point of the morning. We're talking, I think, almost 85 lakh shares trading. So yeah, a lot of excitement there.
A lot of excitement, and where are we at now with regards to Nifty Bank is now kind of in the slightly in the red. Maybe just put up two indices. One is the Nifty IT Services Index, and I think that'll give us a quick sense of what's happening after the 3% pop. It's up another 1/3% higher, and maybe just look at the Nifty PSU Bank Index as well, where I think you will have some change coming up. It's absolutely flat. So. It's done very well, but I mean, this is another area, at least if you look at, just the overall mood, people seem to be very, very bullish. Okay, individual names, etc., still coming on. Maybe we look at something like a Loris Laboratories, where there's been some buzz of a block for the last couple of days. I think it was part of Nimesh's chatter list as well. It's down another 10. It's been coming off last 2 days. Yeah, another 1% odd lower at this point in time. So enough and more activity coming up at this stage. The Mahindra & Mahindra stock, right? I mean, it's the analyst day at Mahindra & Mahindra, and it's a big one. It's a big affair with all the group and company-specific CEOs there present. We'll have something very special from that for you, later. But I think, long-term guidance, etc., is something which markets will wait out for from the Mahindra management and, of course, individual company CEOs from the group as well. Okay, Sandeep Tandon is with us, founder and CIO, Quant Mutual Fund. Sandeep, good morning. Great to have you with us here. Thank you very much for joining us. It's been a while since we've had you on the program, so good to see you. So just update us with your view, Sandeep, just to begin with, and then we can build on that. What's your sense, markets?
Prashant, I have been slightly more constructive than the market participants in general for maybe for 1.5 months or so.
Yeah.
I'm saying that on a couple of reasons. See, first of all, let's talk about the important concern and why we're positive. The most important thing which we think we believe will support the market, the USD INR pair long-term depreciating cycle is peaking out. Okay, which means the probability of appreciation from the current level is very high, and at least the downside is getting capped. So that's a very important phenomenon. Second thing, we are also looking at exhaustion seen the FIS selling. The FIS selling exhaustion we have seen, and we all know December it will die down further, and January is the new year allocation. So that could be a second trigger. Second, the third most important thing is the earnings cycle. We have been quite vocal. We have been saying that September quarter earnings should bottom out, and I believe it has bottomed out. The earnings were much better than the consensus. Don't compare YOY or quarter-on-quarter, but compare with the consensus. So it was far superior. Now you look at additional trigger like GST or income tax benefit or even the lower interest rate, and last most important point, the sentiments. The sentiment is extremely bearish. People have not made money. The frustration is clearly visible. Rotation has been stuck. So it's a psychological problem. The background is constructive that what is required for a pullback rally. And we have talked about that you will see all-time high as early in December itself. And I'm talking about not only the Nifty and the many frontline indices. So we are net constructive, and we are nearly 98% invested in the market.
Okay, Sandeep, hi. All right, so more constructive than most. That's how you're describing it. Good to know. And good to have you with us this morning as well. So tell us then, what's the thinking and what's the approach at this point in time? Because, it's not barring financials, where I think there's a broad consensus. Most people are optimistic on financials. I guess it's been a far more bottom-up market. Within the Nifty, look at the variance. You have a Maruti and Bajaj Finance on one side. You have a Tata Motors, now it's PV on the other side, or other such stocks, that have had a very, very rough year. So how are you looking at, portfolios and fresh allocation at this juncture?
So, Survi, frankly speaking, we are trying to identify the sectors of stocks which are in neglected territory. Let's take example within BFSI. Insurance looks better to me, okay, as compared to banks, because they have now traded in a neglected zone for a while. Similarly, within the BFSI space, the NBFC we have been positive for the last few months. We felt that they are more constructive than the private sector bank. Now, obviously, some of the large private sector bank has also corrected in last few months. So even those names looks pretty attractive from the current level. So our strength comes from the background. We try to identify the neglected territory, hated zone, where people are not keen to build. And you just look at the new age companies. Last 1 year when the opportunities was not there and new age companies were showing at least the top line growth, if not the bottom line. Okay. So the people with money got shifted there. I think that trend has reversed. Money is moving out and moving toward these neglected large cap names where the quality of management is good and earning visibility is even better.
All right. Hi, Sandeep. Good morning. Good to see you. And as always, in terms of your contra call, tech as well, you all were creeping in. Have you increased allocation over there?
On the banking side?
No, tech. Tech, ignored, underperformed, maybe under-owned as well at current reckoning,
Yes.
suddenly showing signs of coming back to life. Tech, are you all increasing exposure?
So we were actually have zero exposure, this exposure. Now we have 5-6% type exposure across various schemes. So we have built. So yes, they were in neglected, it fits into the thesis, and frankly speaking, earnings were better than the expected. Right? So I think they are, but if you ask me, if you are seeing any visible trigger for these names to rally sharply, it's maybe pullback rallies are very much on the card. So I think I will like to capitalize on the current rally and then maybe reassess down the line few months or maybe a quarter or so.
Sandeep, can you talk about some of the unloved, with full disclosure, any specific kind of course, not an inducement to buy anything, but just as an example, where are you seeing opportunities?
As I said, that opportunities is very clearly in some of the private sector because they have some of the large private sector name corrected sharply. Okay, they have been consolidation or correcting phase. I think they are now reaching those neglected zones sort of thing where people have slightly, and these were the names which were in the admired territory for a while. So I think those could be a trading opportunity. Insurance I talked about. I also talked about pharmaceutical as a sector, which I have been generally very bullish for a while. I think US concern has been sorted out and people still don't want to participate in that space. Again, grossly neglected zone. FIs don't own these names, only some of the domestic institutions have some of these names. So these are the areas which I think there could be opportunities. See, we at Quant, we always try to assess our downside. So we always say we are in the business of risk management. Returns are byproduct. So if you can identify, if you can cap your downside, then it works psychological better rather than chasing the momentum. Rather than I will look for at this point when we are very certain that Nifty will make all-time high. I will not be surprised if it make this month. It's okay. So with that background, I would like to look for neglected and beaten down names where we have seen correction and quality or earnings is slightly better. Maybe various reasons people have not liked it or ignored it. So I will prefer to take advantage of this opportunity and build these names in our portfolio.
What about something like a Saman Capital?
We don't comment on individual stock. We don't own and we don't like it.
Okay.
Okay, but since we're talking financials, let me kind of move to another part of it. That's your business, the business you know so well and you've been running for years, Sandeep. Mutual funds, asset management and wealth. And let me also take this opportunity to get your take on the latest proposals, right? So there was that 5 basis points additional charge that was levied in lieu of exit loads when they were banned. So now SEBI is saying, let's not do that. There is some talk of rejigging the TER itself. I'm not talking about the brokerage debate, and I think we've spent enough time on that. But just chip in, generally, if these rules are implemented in their current form, what does it mean for margins and business for AMCs?
So it will affect more the smaller names or the budding mutual fund who are just building up. Because if you really look at, if I go by all the cost structures in the mutual fund industry, it takes typically 8 to 10 years to achieve a break even. Okay. Now, if these new rules are implemented exactly in this form, obviously we expect that break even can extend it to 12 to 15 years. And that will be not a good news for the mutual fund, particularly for the new players. The existing large players have crossed that boundaries. Okay. So it doesn't affect them actually. In fact, they will be actually indirectly beneficiary if the smaller names or smaller companies get affected. See the one is the not only tier part, the second most important is also the brokerage piece. I will touch base again because if you cut down to 2 bits, okay, this is the area where people actually put in effort on the intellect side. Okay, so what we have requested to the regulator is that please look into all the cost structures of other entities, okay, who are the supporting system of mutual fund. They have grown along with the mutual fund industry, but the rules are not applicable in terms of capping their income, where we are capping our revenues of the mutual fund, and we are now talking about on the brokerage side, because if the brokerage rates cut down, simply the incentive of a market in terms of research will be impacted, because ultimately sell side do a better job in terms of depth, and the breadth of the market is very important. We cannot cover 1,000, 2,000 stocks. Neither we have bandwidth, nor we have that much capital to do it. And one client-centric research is always going to be challenging. So what is very important is that we should not hold. If you make it 2 bips and someone, let's say today any smart money manager wants to move and set up his own company, nobody will service him. And 2 bips he will not get the service. And then if he has to build the entire cost structure of 10 analysts or 15 sector specific people.
It's not viable.
It's not viable. Even if it's not break even, he will never able to actually break even in his life. That's the way I define it. Because it will take long time. So what is our urge to the regulator is that we are very happy. I agree the cost structure should come down as the size has grown. The benefit should be passed. but this should be applicable to the other supporting system also. Okay. And that is very important because all other supporting system are largely electronic. They are still charging on AUM basis, not on the transaction basis. So on the intellect side, we are trying to cut it, but on other side, we are not. That's, I think, a lot of messages and the presentation has gone. I'm sure the regulator will look into it. So we remain optimistic on that side. And so far, yeah.
Yeah, no, absolutely. Take your point, and I think I've heard a similar argument from a lot of other AMC heads as well. That mutual fund houses do not have the capacity to set up full-blown research teams, and for the smaller guys, it will be very costly, like you explained. But the other proposals, if TER changes, are what that consultation paper has indicated, and if that 5 basis points additional charge is no longer, applied, then will that hit profitability? And if yes, by how much? I mean, from the point of view of investors who are investing in mutual fund stocks, I mean, I'm asking from their perspective, what should, what can the outcome be with the current proposed TER structures and this 5 bips?
So the way I understand that 5 bips, obviously it was a temporary phenomenon, the SEBI is explained, which is it will not make any meaningful difference. The difference will come if you cut down that 15 bip structures and other thing that will affect, I said, smaller names. As far as large ANC and listed AMC space is concerned, I don't think there'll be any impact because they will pass it back. So basically, the net, the distribution, it will impact the distribution circle. So the people who are distributing the market intermediaries, MUT sort of people will be impacted much more than AMC because AMC will pass.
Right.
Okay.
All right.
Before we run out of time, Sandeep, you have a broader view on other asset classes, etc. as well. You track so much. The big debate has been whether, what's happening in the US is set up for more than a garden variety. NASDAQ is already about 7% off the highs. So is this just a technical shakeout which will correct itself and things will be back on track? Or what's your sense? And how does it affect us, if at all?
See, in fact, I will say in last many quarters, India is actually becoming a low beta market. Okay. And we have a negative correlation with the global markets, not the historical, but I'm talking about last many quarters, we have seen this phenomena. So with that background, if the global market corrects, India will be beneficiary in terms of money flow. Okay. But so it will be always be a psychological impact. In fact, you've seen recent few days or last 1 month where US and developed market corrected, emerging market also corrected. We have not been impacted. It's just the opening is slightly weak and then we recover. See, we have to also understand India has underperformed for last many quarters. So with that background, we should be constructive. As far US is concerned, for last many months, I've been highlighting the risk is not in India. It's the global market, particularly US, where complacency was on a higher side and hence this correction you are seeing. But if you really ask me, this is a bubble, and then answer is big no. When everybody believes this is a bubble, and I don't think anybody really able to identify 2008 bubble was good. So if from that perspective, my only point, and somebody is even identified to say that this guy has identified previous one bubble, so his track record is great. So I think just one cycle or two cycle you catch it and then you try to conclude because somebody has got it and somebody is making a statement. As a behavior analyst doesn't gel well very much with that thesis. And I always say when actually peaks out, that's a time when people will not believe it. People say, oh, we heard this phenomenon in 2025 also. So let's go and participate. That's the time the real problem starts. So I think this could be a small trailer. Maybe the ugly picture is which is pending much later.
Sandeep, it's the individual investors who are raising this bubble noise, etc. The mainstream, global research banks, etc. They're all very clearly saying that no, it is not.
If you ask me, they never do it. Even 2008, none of the bankers.
That is why I'm asking the question. If they were all saying yes, it is, then that is the question. Because actually, the consensus is not that it is a bubble. Consensus is not a bubble, and hence the question. but I take your point that you can't bet on not one hit wonders, but just because someone got a call right, you can't kind of sort of say that they'll get everything right. We have enough of those experiences.
If you say small hype, answer is yes. Okay. But if you say it's a real bubble, because it is backed by earnings, it's backed by numbers. It's not like the P just expanded. In fact, I will say if there is a bubble as compared to US, Indian new age companies have much far bigger bubble. If I go by this definition, then Indian companies have far bigger bubble than the US, because US companies still show numbers. Okay, so valuation wise, they're still attractive as compared to Indian new age companies. So bubble is actually here, not in the US.
Any of the newly listed companies did you all get in? Any of the newly?
No, we very rarely subscribe these names because it doesn't fit into our thesis of. See, Nigel, if you recollect, we have been taught, we used to give 2-3 times sales multiple only to the branded companies, and that's the way we learned. From market cap to sales perspective, or if not market cap to sales perspective, it's largely few brands used to get 3 times, 4 times, 7 times only in the pharmaceutical space as a FMCG. Now none of the companies make money, and we want to give multiple of 10 times sales, 20 times sales, okay? Because earnings will not be visible. So we have been taught about cash flow, but nobody looks into it. So that's the way the phase comes. Majority of the even smart people get carried away. And that is the phase which we are going through. You have to live with that.
Because, Sandeep started by saying that he's looking at the unloved parts of the market. And these new listings are getting a lot of love. They're getting 10 times sales love, 11 times sales love. So too much love is happening over there. But take your caution on board. Sandeep, great conversation as always. Thank you so much for joining in. And you have a good rest of the day as well. Okay, quick check on the market before we move on. And the green is sustaining on the screen, 26,100 precisely, exactly on the Nifty. For the time being, the Bank Nifty is a little sluggish. It's absolutely flat with a slight red bias. The Nifty is okay for the time being. Okay, a couple of interesting stocks to take note of. NBCC, which announced a big order win. There's some news on Cummins as well. Vinny's here with more. Vinny.
Hi, good morning. So first I'll start with Cummins. There's a brokerage note that's come in from Citi. They've given a target price of 4,875 buy rating. Now, they mainly met with the management of Cummins. So key highlights that came in over there. They said Cummins India, they're expecting steady demand, especially for the power generator side, as well as from real estate, construction, as well as infrastructure side of the sector. They're seeing good demand there. In terms of data center demand, they said providers are seeing steady demand there with lumpy hyperscale demand. So that is one thing that one will watch out for. Industrial segments, weakness in Q2 is what we saw, and that we had spoken about it, and that is transitory. That will start seeing an improvement going forward. They see potential in the railway, defense, as well as marine side in terms of improvement for the infrastructure, industrial side of the segment. And that is why they're maintaining the buy rating. Target price is at 4,875. Now, the other one is NBCC, good big order win coming in for the company, 2,966 crores. This order is from Nagpur Metropolitan Region of Development Authority. This is for a project management consultancy order. And obviously, this is a very big order win for the company. So it turns out to be positive because the order book continues to be healthy, as well as future revenue visibility improves, and that is why NBCC also is seeing a positive move.
Okay, all right, got that, Vinny. Thanks very much. Let's now shift gears and actually move to the auto space. Growth seems to be holding up well post the festive season. At least that's what the latest Vahan data is indicating. Let's try and understand this better. We have with us Saharsh Damani, CEO of FADA, and also Shailendra Luthra, Director of Bright Group. Gentlemen, thank you so much for being with us. So we were just looking at the trends, right? And Vahan put out the latest data. This is 1 week after the festive season versus 1 week after the festive season last year. So calendar, the dates don't match, but it is like to like in that sense. And it seems, if I go with those numbers, that on the passenger vehicle side, the growth is 14%, and the two-wheeler side, the growth is 29%. So that's the real question, gentlemen. This burst of festive GST cuts, all of that excitement, was that just a festive season phenomena? Or do you think demand is going to stay strong for the next couple of months ahead as well? Mr. Luthra?
Well, the market sentiment is quite positive. And at the dealer side, the dealers are seeing a surge in the demand. The customers are lining up. There's a good order book which is in hand. And as far as you quoted Vahan data, there is an upsurge in Vahan data also. These are the registrations post the festive seasons. So from my perspective, from the outlook that I see, I don't see the demand going down. There's a robust demand, and which will continue, and it will be sustained demand with the new affordability and thanks to the GST cuts.
Okay, let's actually bring in Mr. Damani and get the FADA view in as well. What are you hearing from dealerships, from the entire network? Is it as strong as what we saw around Diwali? Because the big fear in the market is that this will taper off. You know, it may not extend into the remainder of this year and next fiscal year.
Yeah, so good morning and thank you for having me on your show. But before diving into your question, I just wanted to acknowledge an important milestone, and it has now been 7 years since FADA began publishing the Vahan-based retail data. What started with a fair bit of skepticism has today become the industry's most trusted lens to assess real demand. Coming to your question, I think what we are hearing from all across the country right now is demand is robust, and it is not only a festival phenomenon, but this month, the month of November, you're seeing a lot of marriage days coming in. So that's keeping the demand healthy. Going forward in the month of December also, since it is the year end and the calendar year change, we will witness great schemes coming in from all the OEMs across the board. And that will again, once again, pull market in the green. So till December, demand is good. What we need to understand is there are customers available at the right price point. So we need to see that beginning the new calendar year, OEMs continue to attract the customers with excellent schemes, the way the schemes are running right now in the market. If those continue, demand will continue to remain robust till FY end.
So Saharsh, I know it's a bit of a tough question, but some sense, say if we talk about October, November, December, you know, this last quarter of the current calendar year, what is the growth that you would expect? And I'm talking about, you know, end level retail growth, those registration numbers, which that 1 week that was reported is looking very, very strong. But as we normalize O&D, how much growth for two-wheelers and how much growth for four-wheelers would you expect?
So if I give you an historic data from April to October, we have seen two-wheelers growing at the rate of 12.5%, and passenger vehicles again growing at upwards of 5.5%. At the beginning of financial year, we had estimated that the passenger vehicle growth will be in low single digit. But because of the GST 2.0, which has come into picture and come into play, the run rate has gone up. And for this October, November, December quarter, I think the run rate will be above the average of 4.5%, what we had seen until September this month. So that's what we are looking at in the passenger vehicle segment. In the two-wheeler space, the growth should be in high single digit. That is what we are expecting.
Okay, but that's not saying much, right? Saharsh, you're saying that it should be above the 4% run rate. That it has to be, that we know with the demand thrust. Okay, let me ask you a broader question. You started the year saying on the passenger vehicle side, growth should be around, 4-odd%, right? Yeah. Now what are you expecting? Double-digit growth for passenger vehicles this year, fiscal year?
No, we don't expect double-digit growth, but we definitely expect growth to be above 5.5% mark, maybe somewhere around the 6% mark. So that is what we are expecting. And this growth has been upwards because at the beginning of FY, we had estimated around 2 to 3% growth. So if 5.5 to 6% growth comes, this will be double of what we had expected. So I think this will be a good number to close the year with.
And what about passenger vehicles? That's helpful. So what you're saying from an expectation of 4% growth in passenger vehicles, you're now hoping the year will end with at least 6.5% growth. Similarly, for passenger vehicles, if you could can you give us some sense?
So this was for passenger vehicles.
For two-wheelers, I beg your pardon. Two-wheelers, yeah.
Yeah. So for two-wheelers, we expect that 9 to 10% growth should be easily achievable by the end of FY.
Okay. All right. Hi, gentlemen. Good morning. Good to see you all in. Mr. Luthra, there's a bit of a split verdict with regard to the tweak in the emission norms based on the weight of a vehicle. What is your view on that?
Well, on the emission norms, the government is changing certain policies and certain decisions, but the manufacturers would be supporting that. The OEMs would be supporting that and ensuring that the customer sentiment doesn't get hampered with it. And on the society perspective point of view, we should be having some more stricter norms considering the environment we live in. But let me also tell this to you: India is a torchbearer as far as emission norms are concerned. We are way ahead many other countries of the developed world. And I'm sure both the consumers and the OEMs would be lapping it up easily. We have geared up to come to that level.
But this change, not change actually, it's this hike in the price of re-registering your vehicle, basically getting that fitness certificate again. That increase, do you expect it to spur demand a little more? And is that only at the entry-level segments? I'm guessing in the premium segments, these things don't really matter anyway. But Mr. Luthra, would you expect this to add to it?
You are talking about the re-registration of the vehicle after the end of life.
Yes, yes. Those charges are going up, right?
Yes, that is going up. But after the end of life, there would be not a big percentage of people who would be going in for re-registration, because the overall aspiration and the demand to change is very high. And it is also possible that in the coming future, this is my appeal from your medium to the government, we might see some good incentives for scrapping of the cars and buying new cars for the recycling. So overall, I don't think it will have a significant impact that many people would be going in for re-registration. But yes, it would act as a deterrent for sure.
Just, gentlemen, one quick question. We haven't discussed EVs. Now, in this new era of lower GST, the whole ICE versus EV debate, Saharsh, if you could come in on this as well, because it seems the growth in EV sales is not as high as what the OEMs would have liked. What are you seeing on ground? What is the and what are the estimates between ICE and EV looking at the next couple of months?
Yeah, so just to give you a perspective, two-wheelers right now in the EV space, they have around 8 to 9% market share. And in the passenger vehicle market share, the EV contribution is around 5%. Barring the month of October, we have been seeing slow growth coming in both these categories. And the growth is largely coming because more established players are now coming into the market in the two-wheeler space, especially with the likes of Hero, Bajaj, and TVS. Also in the car segment, if you see more and more products are getting lined up in the EV space and also in the alternative fuel space. So as customers get more choices, I'm sure these numbers will go up. But if I were to talk about, say, next six months to 9 months period, two-wheeler should see EV penetration of at least 15%, and electric vehicles in the passenger vehicle segment should see again 8 to 9% growth.
Okay, all right. So perhaps the EV penetration will pick up in the months ahead. Thank you very much, gentlemen, for joining in and giving us some perspective on how the auto sector is shaping up after a bumper festive season. So trends looking good, and FADA saying that for the passenger vehicle space for the year as a whole, they now think that growth should be in the vicinity of 6 to 6.5%. Let's take a quick break on that note. We'll come back on the other side and we'll get chatting with Neha Agarwal of JM Financial Institutional Securities.
Welcome back. This is Corporate Radar, and the markets continue to hold in the green as we speak, marginally 30-40 points or thereabouts. But as promised, we have Neha Agarwal, the MD and Head of Equity Capital Market, JM Financial Institutional Securities, who joins us on the show. Hi, Neha. Good morning. Good to see you again. Well, let's address the point with regard to the fundraisers that we've seen this year. It's been very, very strong. My query to you is, do you expect this sort of a momentum to continue? If you could, break it up in terms of a number as well. And also the worry is, India is turning out to be the IPO factory. Are you worried about the quality of paper that's hitting the market?
Am I audible?
Yes.
Thank you for the question. I'm actually not worried. I'm very enthused with what's happening. You're actually seeing a confluence of entrepreneurial energy with investor appetite. It's really not an array of indiscriminate issuances which are happening. I think investors are evolving to proper filtration of data, strong management equivalence of corporate governance. They're believing in business models. And wherever we're seeing that there's even an iota of doubt on how the business will evolve, markets push back. So I think that filtration is becoming extremely key for the success of markets. Let me give you a few data stats, right? Calendar year 24, we saw close to 1.5 lakh crores of equity issuances on the main board. Continuing the trend, calendar year 25, with another 6 weeks to go, I think that we will probably beat the last year's high. As we speak, there are more than 200 documents filed with the regulator. If I really had to put some bit of probability, some bit of filtration, with many more transactions to file, I wouldn't be surprised if the next 12 months, we see 2.5 lakh to 3 lakh crores of equity raise with a lot of filtrations in the way the investors are valuing it. So I think it's a great time for Indian primary markets.
This is a spirited defense, Neha. Not that it needed to be defended, but point well taken. Morning, Prashant here. I spoke with Vishal yesterday, and he said, well, the pipeline is going to be a bumper into 26. Of course, all of it depends on markets and what secondary markets hold up like, and that no one knows. So if the demand goes down, supply, I guess, will recalibrate accordingly. But I mean, with NSE lined up and others lined up, I guess the numbers will be much larger. Which sectors, Neha, if you can give us a sense, are you seeing the maximum activity in? You're expected to see maximum activity in as we look into 26.
No, I think what is really different from raises, what we've seen the last 5-7 years, is this time it's all around. We're seeing sectors from new age tech, investors really giving credibility to large business models. We're seeing in renewable energy a lot of interest. We're seeing manufacturing take a large part of the mind share of the investors. If you see precision, R&D involvement in manufacturing, autocoms, I think we're a great bull over there as a house. We believe anything which involves the precision element into it, investors are lapping it up. They're expecting a large deluge of fundraise, in fact, in these three subsectors. I'm actually not a fan to see hot sectors, only some subsectors get capital. I think it's well bound this point of time. I think that's great for Indian markets.
So in a way, manufacturing, right, Neha? You think we'll see a much larger share of manufacturing businesses come into the market in 26?
In all our conversations, we're definitely seeing that mirror through primary markets. I think a lot of the growth capital is going to get infused via IPOs in probably the next 12 to 15 months to come. But I must caveat that this is to do a lot with, it's not commoditized manufacturing. It's, like I mentioned, it's a lot to do which is R&D backed, this technology. You're seeing the essence of precision come into manufacturing. And I think that itself will be spearheading a lot of our growth.
Neha, just one more question, just playing the devil's advocate here. I spoke with Sanjeev Prasad of Kotak yesterday on the sidelines of a forum, and he gave a statistic. He said over the last 5 years, there's about $100 billion worth of money which has been raised through IPOs. Only 15% of it, according to him, has gone into building assets, plant and machinery. Bulk of, everything else is basically exits. So it's a slightly broader question. It's about the so-called smart folk are selling, which is early investors, promoters, and it's, of course, en masse being bought by retail because foreigners aren't really there at this point. So just wanted you to address that. The number, that statistic was pretty stark.
No, I think the data point is correct, but I would put it in a very different perspective, right? So of the $100 billion, it's about $20 billion, which is primary infusion, and primary infusion has been to delever our balance sheets largely, or primary capex. But let's not forget, in the 80 billion, a large percentages of it is private equity monetizations. Now, how do the capital of PEs really come in, right? In the last 10 years, we've seen close to $400 billion of private equity raise for corporate India. They've incubated businesses. They've helped entrepreneurs grow. And after the company has reached a particular maturity in operational metric, they've gone and monetized their stake sale, which gives a huge vote of confidence to the boardrooms of those private equity investors sitting globally for them to infuse more money and incubate new businesses. So I actually think private equity monetizations is a great thing for Indian markets. Yeah. So yes, they've not gone to delever balance sheets, but they've gone to help businesses evolve.
Absolutely, and that's an argument that we've heard from some of the larger private equity giants as well. Exactly that unless they monetize, how will they fund the next wave of ventures? But Neha, that's the morality argument that Prashant raised with you. I have the money question now, which is probably the most juicy part of this IPO debate, right? The pricing and the valuations that you folk are able to negotiate and get through, and kudos to you. I mean, the investment banking community, because you're able to secure whether they're exits, whether it's fresh money for the company. Now, that valuation, conversation, I just want to understand what's going on behind the scenes, especially when you're talking about new age businesses, these consumer tech, companies or platform companies. Is the pricing going higher and higher because there is a FOMO in the market? We don't have too much AI, we don't have deep tech, but we have a lot of consumer tech, and everybody wants to be on that train. Is that what is driving the pricing higher? Just walk us through the pricing mechanics.
Like I've always said this multiple times, IPO pricing in India, there's really no math or science to it, right? It's literally an art. It's a judgment. Investors are out there backing ideas, they're backing concepts, they're trusting the management team. I don't think now markets have matured. I don't hear investors telling me, let's look at 1 year forward revenues, look at guidances. I think they're graduating to quality. I think what's very, very important to the point of filtration, which I was telling you all earlier, is investors are backing business models. And to my mind, that is extremely refreshing when they're pricing transactions. And these aren't centered by 2 or 3 funds deciding valuation, right? You've gone out there, you've met more than 100 investors globally, domestically. And after consciously having those conversations, they're backing models. And that's how the IPO pricing, the judgment as to and if you see the last 5 to 6 months, the IPO pricing has been very accommodative. I think issuers have respected investor feedback, they valued it, and thereby you see at least 20-25% return on listing. I think what's important right now, to my mind, is the sustenance of this listing price, which will be backed up only by good corporate earnings in the quarters to come.
Which just reminded me about Lenskart. I'm just checking the price on the screen right now, 420, because every time we have such high-profile issues coming up, that debate rages. So just to complete this point, Neha, for investors who need to understand how the new valuation parameters are working, so say a price to sales, is that here to stay? I mean, what is the learning curve that regular retail investors need to kind of, go up with? Because this is no longer about traditional price to book or traditional price to earnings, right?
No, I agree with you. I think there was inertia even with institutional investors probably a few years back because they were backing new business ideas. The point of validation wasn't proven in the markets. But off late, if you see with all the listed comps, the unit economics is working in their favor. They've delivered to their promises. And I think that itself is confidence building for retail. I'm a better fan of retail investors also plugging in some bit of the capital via mutual funds. Mutual funds, let them do their work. That's what they're meant to do. And those business models are being priced on revenue going forward. However, there is an implied multiple that they're working off on the PE or EV/EBITDA for those businesses going forward by the institutional investors. So I think, again, the point of validation is the listed peers have done extremely well, delivered what they had promised to the investors at large. And I think that is giving the confidence to the new issuers when it comes to pricing discussions.
Well, it's a pleasure, Neha. We wish you all the best of luck. Thank you very much for joining us. Interesting chat here on CNBC TV18 from the sidelines, the JM conference, which is underway. Thank you. Okay, well, we'll take a quick commercial break here. We're going to come back in just a bit from now. I think past 10 now, and it's quietened down. 29 points higher, 26,080. There's grow at the bottom of the screen, another 7% cut. So Ruby, I was just looking at, we're talking about Nvidia. We don't have Nvidia here, although Deepan said if Nvidia was listed here, it would command some double valuations and all. No Nvidia, but we have NetWeb.
Yeah, that's true. The closest we get to Nvidia.
We should have, I mean, to be fair, they are one of the...
They're a supplier, right?
Yeah, there are less than 10 licensed suppliers of Nvidia globally. That's a pretty big deal, right? And NetWeb is one of them. And the stock should come up. It's up about 6%. Of course, it fell 1,000 rupees quickly from the highs. So there is that element of this as well, the lift that it is getting now. But it's interesting. If you can have NetWeb up, please. There you go. That's the stock, about 200 rupees higher, back to close to about 3,500 rupees. We'll take a quick commercial break here. We're going to come back. Vinay Rajani of HDFC Securities for technical trading ideas. Stay tuned. Coming up. Okay, welcome back. 40 points higher, 26,100, just under that level, by the way, holding on at this stage. Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good to have you with us here. Good morning. On the indices, any trades, Nifty Bank and specific stocks?
Yeah, good morning. So Nifty has crossed the 26,100 in the morning, definitely because of the positive global cues. But somehow the cash market stocks are not moving that much with that much momentum. So though the trend has been good, but the trend is good for the large caps only, the F&O stocks only, and sector rotation is going on. So we need to be vigilant about selecting the sector and stocks. So yes, IT has been supporting capital markets, defense, have also been into a positive trend. So selectively we are bullish, and Nifty is definitely into an uptrend, and we should not take trade against the trend. The yesterday's low, which was around 25,800, 850, should be the stop loss in trading long position. And ultimately, Nifty can take out the previous all-time high, which was placed around 26 to 77. So yes, overall trend is positive, though the choppiness is there. But keeping a stop loss at 25,850, one can remain long with a target of 26,300. And right now, the capital market and defense space has been showing strength. IT is the another sector which one can look for the trading. Cash market stocks one should avoid because momentum is clearly missing there. So yes, overall stock specific markets are good. Banking have been performing well, but since IT has taken the lead since yesterday, banking stocks can consolidate a bit for a time being. But overall markets are looking good, and 25,850 should be the stop loss in trading long positions.
Okay, Vinay, so what are the specific stock trades for today then?
Yeah, so as I said, the capital market theme today has been doing very well. So MCX is one of the stock which we like on the charts, and it is making all-time highs day by day and looking strong. So MCX is into a clear-cut momentum, bullish momentum. So 9930, 9950 should be the entry price. 9770 should be the stop loss. On the upside, we are targeting a level of 10,250. So this is a trading target for MCX. The second stock I would take from the defense space. This is another space which is doing well since morning and overall into an uptrend. So Bharat Electronics is looking good. 425 should be the entry price. Stop loss should be kept at 418. On the upside, I'm expecting a target of 435.
Okay, all right. Thank you very much, Vinay, for the trades and for the technical advice on the index as well. The index is still up about 50 odd points. Let's go back and revisit Sammaan Capital. Stock has been a little volatile. It's still down about 0.5%. Gaurav, fill us in on the latest and what the company has said about the whole court order yesterday.
Well, yes, when we look at Sammaan Capital, yesterday was a disaster, but now company has come up with a clarification. So before I go to what happened yesterday, let me tell you a background story. In 2019, a PIL was filed against Sammaan Capital and the promoter. In 2024, Delhi High Court actually rejected the PIL, saying that the proceedings that they had filed and appeals that they had made were not right. Apart from that, company also said that the PIL, which was specifically filed for the 5 specific accounts, they have recovered most of the money in 2019 and there is no account receivable from these accounts as of now. Now, what happened yesterday? In October 2024, there was an appeal made in front of the Supreme Court against Delhi High Court's judgment that was given. And based on that, what company now says is that there are no open investigations specifically pertaining to the allegations which were made in PIL earlier against Sammaan Capital, neither from the investigative agencies or from the regulatory bodies like RBI. Apart from that, they also said that the court did not find any wrongdoings against Sammaan Capital in this case. And lastly, the Honorable Supreme Court also said that we have not expressed any opinion against Sammaan Capital. So this is important to note. Apart from that, the current proceedings which are ongoing are for the petitioner's submission for the earlier promoter, Mr. Gehlot, and who has fled the country and now has settled in London. Apart from that, Mr. Gehlot is not a part of the company right now. And when we look at the IHC deal, now company also says that both IHC and Sammaan Capital continue to remain focused on making this deal happen and make IHC as a promoter of the company. So definitely, company has shown confidence that the business ongoing is sound. And apart from that, there are no concerns raised by the Supreme Court. And on back of that, we will definitely watch out on this stock today.
Okay, all right, Gaurav, thanks very much for that. Stock's actually absolutely flat, unchanged from where it was yesterday. So a sharp slide at open and then it's picked up from there. You know, Hero MotoCorp has crossed 6,000 for the first time since September 2024. I think we've had 2 upgrades in the last 2 days. Yesterday, I think there was an upgrade I think from JP Morgan, I think. And then I think there's one today as well, this morning as well. So more on that a little later. We'll take a break. We are back. Lata in conversation with HSBC's Pranjul Bhandari on It's the Economy segment coming up in just a bit.
Welcome to It's the Economy. India's macros present a very pretty picture. Most economists are now expecting the second quarter GDP numbers that will be announced next week to come in well over 7%, and indeed, some are even moving the full year GDP forecast to over 7%. Meanwhile, the CPI inflation, consumer inflation, is expected to be lowered by the Reserve Bank to 2% for the current year, after the record low of 0.25% that the CPI touched in October. The only fly in the macro ointment is the record high trade deficit that the country reported in October because of high gold prices, high gold imports, and lower exports to the US. The other fly in the ointment is the continuous outflow of dollars by foreign investors. To get a handle on all things macro, I have with me Pranjal Bhandari, the Chief India Economist and Strategist for HSBC. She's also the ASEAN economist for HSBC. Good morning, Pranjal. Thank you very much indeed for joining me. Let me start with the GDP numbers. Our poll is only halfway through, but it is giving a very clear indication that we may get a number above 7% for the July, August, September quarter. Where do you stand?
Yes, absolutely. I think September is going to be a number which is going to be close to 7.5%. I think December too, we could be in the 7% plus range. So we're talking about pretty strong growth over, the first 3 quarters of the fiscal year. I think a lot of things have supported this, from good monsoons, low inflation, which raises purchasing power, tax cuts, front loading in fiscal expenditure, especially in capex. I think all of this has come together very nicely. But Lata, once I say this, I think it's also very important to look ahead. And my sense is that some of these things could reverse in the March quarter, which is the final quarter of FY26. And there are a few uncertainties which we can't ignore. I think one uncertainty is that all of this GST boost we are seeing, will that continue or will that fade? My sense is we are already seeing auto companies taking away some of the discounts. Some of the passenger vehicle registrations have come off. So we'll have to think about the longevity carefully of all of the GST boost. The second is the fiscal drag. The government has spent a lot upfront, but now nominal GDP growth is very low. Tax revenues are lower than budgeted. So they may not have the firepower to spend very much in the March quarter. In fact, they may have to cut back on spending, and that could be a fiscal drag. And the third is exports. We are finally seeing in the numbers that exports are slowing, especially to the US, but it's not that we are being able to increase exports in a major way to the rest of the world either. So I'm not seeing evidence of rerouting of exports. So my sense is we could see 7% plus numbers for the first 3 quarters, but suddenly in the fourth quarter, the number could dip to as low as 6%.
Oh, really? Actually, you kind of answered the question that I had, just an optimistic spin. Are we all being overcautious about our economy? Has the country's potential growth actually increased for various reasons? The demographic dividend, when China was in the same situation as we were, they were reporting 12 to 14% GDP. So probably we are in the 7 to 8% bracket, you don't think, for the coming few years?
Well, I think, the uncertainties that I spoke about are uncertainties which we should think about very carefully. Globally, growth in 2025 has been pretty strong, higher than expected across the world. But a lot of it has also been led by front loading of exports, because a lot of people fear what will happen once the tariffs kicking in a major way. And our sense is that because so many countries have already imported what they wanted for a year or so, actually exports in 2026 could be much lower. And globally, growth may be weaker in 2026 compared to where it's been in 2025. And, India will be a part of that as well. So while I'm very happy with all we have achieved, and we have achieved a lot, I do think we need to be careful about the uncertainties in the global growth environment in 2026.
No, I take a point. The world is not as clement to us as it was to the Chinese in the 90s and the 2000s. Let me come to inflation, where you will have a better picture since you also look at ASEAN. We have this 0.25% CPI number, and much of this is because the WPI numbers are way negative. We have probably the 5th consecutive month of a minus wholesale price number, deflation. Does that continue? Because, Asia is getting flooded with cheaper exports which couldn't go to the US. So do we have an Asian disinflation related low inflation in India as well for the better part of 2026?
Absolutely, Lata. I think low inflation is going to be a new trend out there. And on the back of that, I'm going to argue that the RBI can remain growth supportive for a pretty long time. When I look at very short-term data, we got this amazing 0.25% CPI number for October, and that did not even include all of the fall in the GST taxes. It only included a very part of it, about 1/3 of the impact. So I think that is also likely to come in a bigger way in the next couple of months. So inflation could remain low in the next couple of months too. And coming to 2026 and beyond, I have done a structural study in which I've looked at previous periods in which core inflation fell as dramatically as it's falling now. Every time in the past, it was led by growth falling. It was output gap widening that led to lower inflation. And therefore, it used to be very short-termist. As soon as growth would rise, inflation would go back up again. This time, when I'm looking at the drivers of disinflation, they are structural. It's China's overcapacity in manufacturing and therefore, cheaper imports. And that has been built over 4 decades. So that's not going to go away very quickly. And it's also RBI's credibility that has been built over 10 years as the inflation targeter, that they will keep inflation low, and markets have started to believe that. These are all structural drivers that are driving today's disinflation. And my sense is that's going to continue for a fairly long period of time. In terms of numbers, I would say for FY26 average, I think inflation can be below 2%, about 1.8%. And for FY27, I would say it can be a tad below 4% at about 3.8, 3.9%. So these are pretty low numbers for several quarters.
Okay, this actually makes the Reserve Bank, renege on its promise. It's a renege on its mandate. It's supposed to keep inflation above 2%. So how many cuts? And what in December?
Yeah, we do think that there is a cut in December. Although I must say, I think markets are right now 50-50 on it, because they are saying, yes, we understand inflation is very low, but growth is extremely strong. Why should the RBI cut? And my argument there is that actually the primary mandate of RBI is inflation targeting. So at this point of time, they'll be looking at inflation a little more closely than they look at growth. And even when I speak about growth, yes, it's strong today, but I think in early 2026, things look a little bit uncertain on the growth front. So on balance, my sense is that the RBI will be cutting in December. And beyond that, my sense is, look, we do have space for a rate cut, another one. But it could be in February or April. But right now, I'm going to focus on the December cut.
Okay, your terminal rate, therefore, is 5% for India, the repo rate.
Closer to that,
okay.
Yes.
Now, while it's very good that inflation is coming in lower than what RBI thought and growth is coming in higher than what RBI thought, what you are saying gives me the feeling that nominal GDP is going to be, sub 9%, not even sub 10% for FY27 as well.
Look, my sense is that, WPI is a funny animal. If it's going into deflation for next 2-3 months, it could be a very strong positive number just 1 year down the line. So from that perspective, GDP deflator could be a little higher in FY27, and we could just about touch double digits in nominal GDP growth, just about 10%. That's what.
Okay.
That's what I would
the
think.
reason why I'm asking is it's not just the government's fiscal deficit. It's also EPSs of companies that are linked to the nominal GDP. And if that continues to come between 8 and 9, we have a problem in terms of earnings. Since you are also a strategist for HSBC, this is my question to you. Do you see foreign funds, therefore, changing tack? The second quarter EPS growth has been far better. It ends a long 5-quarter drought. Do you think that, we can upgrade the earnings forecast for the next 4 quarters? And do you see any sentiment change in FPI? Does it change into inflows anytime soon?
Right. So to the extent corporate earnings link up pretty well and are very correlated with nominal GDP growth, my sense is that December will not look very good, in the sense that we think it's going to be a quarter in which the real GDP growth will be higher than the nominal GDP growth, which basically means that the deflator will be negative. So, you have to keep that at the back of our minds when we think about corporate earnings. But as soon as we hit 2026, my sense is that the base effects will turn favorable. And for FY27, nominal GDP growth could be closer to 10%, whereas in FY26, it was more like 7.5%. So some improvement on the margin there. But a broader point there is, my sense is that globally speaking, when we look at the region, our sense is that because Indian equities haven't done that well over the last year, some of the valuation gap vis-a-vis, the region has actually corrected at this point of time, and things are beginning to look attractive. In fact, we are overweight on equities at this point of time. We've been so for the last 1.5, 2 months. And we can see, I meet a lot of sort of clients, investors around the world. I can see the interest in India has crept back in.
Oh, okay, that's good. So just a final word, do you think the currency stabilizes below the 89 mark, or do you think 89 gets overshot? Just any view that your team will have on the rupee?
Yeah, so look, we've had a trade deficit number which has been extremely large. And my sense is while it could soften going ahead, it's not going to fall dramatically. I think gold imports will remain elevated for a while. My sense is exports will remain challenged for a while. In fact, for FY26, we think current account deficit will be 1.4% of GDP, which is almost $60 billion. Remember, last year it was $25 billion. So the pressure on the currency, I think, could remain at this point of time, especially if we don't see a deal between the US and India very soon. If we see a deal, it could be a game changer. Sentiments can change very quickly. Markets might realize that a lot of the real adjustment has happened, and now maybe it's time for the currency to perform. So it's a very binary view of the world. No deal, my sense is we can go towards 90. And if we have a deal, we could spring back to about the 87 range. So it's a wide range. A lot of it depends on the India-US deal, which is not just good for taking away a growth drag from the economy and bringing back equity flows, but over time, it could actually increase FDI inflows into the economy as people start seeing India as a good manufacturer.
Fair point. Well, a lot hinges on this very binary event. Thank you very much, Prajwal Bhandari, for joining us with a 360-degree perspective of the Indian economy. That's it.
Lovely to be here.
Thank you. That's it on this edition of It's the Economy. It's time for a break, and Chartbusters will come up thereafter.